Yes. What about for a poor person who has $100 in Bitcoin and can't find somebody to lend against it?
It's the principle is the same at all scale, which is you want to divide your assets into a savings account that's in an appreciating asset, BTC, and a checking account that's in a depreciating currency, the same scale. And look, if you're a poor person, the only way you generate wealth is you have to generate assets. So how do you do it? You either create a company, issue yourself the stock, or you have to save money at another job. And then when you save money, you go buy something. You can buy a house with leverage. So if you can make enough for a down payment, then you can buy a house and the house goes up 7% a year. And then you can generate home equity. And lots of people did that, right?
Hmm.
Lots of middle-class people generated wealth by owning their own home because they were able to buy it with leverage. You can't do it without leverage. It's hopeless without leverage. Now, once you've done that, right? I mean, the classic thing is I get a job, I get a down payment, I buy a house, it appreciates, I flip it, I buy another house, I get more debt, I pull the money out, and then I make an intelligent investment in the stock market or intelligent investment in a business that appreciates. Now you have assets.
Right.
Now, what don't you ever want to do? You don't ever want to shrink your balance sheet. Ultimately, what you want to do is construct the balance sheet of the greatest amount of high quality assets. Definition of high quality asset: one that a wealthy person will want to buy in 10 years. That's a good definition.
Sure.
I mean, common sense. A house in the Hamptons is a Picasso. How about, you bought 100 acres in the middle of Kansas and you paid a lot for it. Well, maybe it doesn't seem scarce. It doesn't seem desirable. It's not going to appreciate as fast. So find scarce, desirable assets. The other thing is find something which is not going to force liquidate you. You buy Dogecoin, on margin, and you might get wiped out before you make your money on it, right? So some things are riskier than other things. I think ultimately, the big disservice we do is we tell people, you have to spend something for it to have value. You don't have to spend shares of Apple stock for it to have value. I mean, it's such a freaking stupid thing to say. You don't have to. Mark Zuckerberg never spent a share of Facebook stock to be rich, right? Okay, I got $1 billion of Facebook stock. I'm in real deep trouble because I can't spend it on coffee. No, I pick up the phone, I call the bank, I say I have $1 billion of Facebook stock, and they loan me $100 million at 1% interest. And I spend $100 million over the next 10 years. I never pay income tax. I have no capital gains tax. And the only question is Facebook going to go up or down over time? And if Facebook is a franchise, then when am I going to sell it? The answer is I'm never going to sell it. If you look at John Malone's life, John Malone is one of the great businessmen. He's one of the true genius cable billionaires. And if you read the story of his life, it was all about, I bought this business. I did a tax-free merger with that business. I leveraged up that business. I sold to AT&T and did a tax-free spinoff. I leveraged that business. He still owns all of these cable companies and these cable networks after 40 to 50 years, never selling. And the number one reason is he never wanted to incur a tax, right? It's the tax that kills you, especially capital gains tax. And so you just want to buy assets and you want to find a way to build up your asset portfolio however you can and generally what's the best thing? Long-term, patient, low-cost financing. 10-year debt, 20-year debt. It's like, if you don't believe if you don't believe what you're investing in and you borrow money against it, you're going to get wrecked. Okay, so maybe you don't want to launch a bakery or a restaurant. How about just buy the S&P 500 index with long-term debt? I bet you if you did the analysis for the past 40 years and you considered If someone were to basically take a home equity loan and then reinvest it in the S&P 500 and just roll that forward for decades, you probably would be fine, right?
Sure.
Like that would have been a simple thing. Leverage up your house, take as much equity as you can out of your house and buy the S&P index. And you probably, the S&P is up 10% a year for 100 years. It's up a lot more right now. I think generally you might find 1 year when it might have been ugly, but if you just held that position for your entire life, this simple idea, borrow money cheap and buy a diversified portfolio of company stocks is not an awful idea.